Good morning, good afternoon, good evening, wherever you are watching from. So today I will take you through IPSAS Tolif inventory, and this is my outline. First, we will identify what inventory is, then we will measure the cost to carry. What are the costs? What cost will you use to carry initially and subsequently? Then I will also advise you or take you through the write down to NRV, what you need to recognize as NRV when needed, and recognize the expense. How do we recognize the expense? And then how do we disclose? How do we disclose under this IPSAS TOLIF? So let us dive deep into it by starting with the key definitions. Inventories. Inventories can be explained as asset held for sale, distribution, or consumption in the normal operation of an entity. So that's what inventory is. Inventory is what we consume. Inventories are the raw materials, are the work in progress, are the finished goods, are those items which we transfer for free. Inventory is found everywhere in your stores. So the net realizable value. If you are profit making entity, if your aim is to sell, then you will use the net realizable value. The net realizable value is the estimated selling price less cost to complete and to make the sale. Less cost to complete and to make the sale. So that's net realizable value. And we will look this or revisit when we are looking at what will be the write down and what cost will we use inside in our books as the carrying amount of the inventories. Then there is the current replacement cost. This is used by entities who don't make profit, so entities who provide service to wananchi or the citizens. So what the entity will pay to acquire the asset today. So if you can't compare cost and net realizable value, and yours is to give it for free, what other measurement will you use? You will use the current replacement cost. The current replacement cost. The current replacement cost is the cost when you go back to the market and ask the suppliers through email, formal communication, how much will you give me this for? Or how much can you sell this to me? And once you get several quotes, it is normal for a human to take the cheapest. So, and you have the cheapest. Then you will compare the initial cost against those costs given to you. Why we can't use an NRV and apply to even the public sector? The reason is that in the public sector, we don't sell, we distribute it for free. We distribute it for free. So here are examples of inventory in the public sector. We can have inventories in the military stores, the strategic stockpiles. Inside the military stores are the missiles, ammunition, and others. The strategic stockpiles, like those we normally have the reserves, like the national cereals produce board. We have maize, or we have oil reserves. Then the stamps and currencies, which are kept by the banks and central bank. So those also are inventories, and you don't measure them using the cost you will. For example, if it's a 1,000 note, it is not a 1,000 note in inventory. If it is not yet dispersed, or if it is not yet in circulation for central bank. So for example, you have 1,000 note. That 1,000 note, the central bank will measure the cost of producing that 1,000 note if it is not yet in circulation. But the moment that is in circulation, then 1,000 will be equivalent to 1,000 shillings. Spare parts, those tires, those oil filters, what can I say, the toners, everything are part of inventories under consumables. Work in progress can either be the work in progress for in manufacturing, or the work in progress in services, if you normally offer services to other entities. So what is in and what is out? Goods held for sale is in, or distribution. Materials and supplies to be consumed is in. Work in progress is in. It's covered under this inventory. But what is outside the scope is sometimes financial instruments and IPSAS Tolif share what we can call stock. For example, bond stock, debt stock. So those won't appear here under IPSAS TOLIF. Biological assets at harvest. Biological at harvest, we apply IPSAS 27, which uses fair value less cost to sell. So, for example, you have milked a cow in the farm. So, the milk produced, if it is 5 liters, you will first measure fair value less cost to sell. And then the point when you step out of the farm and go to the stores and take it to the stores, you will carry with the initial measurement of fair value less cost to sell, and that will be the opening balance of your inventories in your stores. And as you consume, then you use either lower of cost or net realizable value or current replacement cost. The work in progress of free or nominal services are not covered. If you give services for free, then you won't put it as inventory. Otherwise, if you give services and this amount you charge which is similar to the current market, then you will be forced to have in them as inventories, as work in progress in your books, because of the matching principle. We match revenue to it is related expenses. Okay, now let us move to measurement. The core rule here is lower of cost, and then we'll go to what cost is, what NRV is. So lower of cost is the net. You will use this decision table and ask yourself, is the net realizable value below cost? If the answer is no, then carry the inventory at cost. So we look at the lower of the two, lower of the cost or NRV. But is the net realizable below? Yes. If the answer is yes, then you ask yourself two more questions. Is it held? Is it held? Is it held for free or a nominal distribution? If it is no, again use the NRV as the measure. But if it is yes, you go to the carry at lower amount, write down the difference, So here you follow this decision table, lower of cost and a net realizable value, or in government we can say net replacement cost. Example: a national referral hospital like the Kenyatta Referral Hospital holds antibiotics that are close to expiry date. Demand has fallen and they can only be used at a reduced value. For example, the initial cost was 800,000. The NRV is 620. At what amount are the drugs current? Give the journal entry for any write down. So, carrying amount is equal to lower of cost, which is 800,000 against 620. Which one is lower? If you look at these figures, 620 is lower. So 800 minus 620, that is 180. So the write down here, the write down expense, which you will take it in the statement of financial performance under if you classify your expenses by economic of classification, normally we take it to use of goods. So write down expense 180,000 and then you reduce. Normally, an asset we debit by nature when increasing an asset. When reducing an asset, we credit. So credit inventory by 180,000. Okay, cost of inventories. Now let us come back to cost. What forms part of cost? Cost of inventories is the cost of purchase. The purchase includes price plus import plus transport less trade discounts. Then cost of conversion, direct labor, production, overheads. Then other costs. What this simply is telling you is any cost that will bring that asset to its present condition and location, you will put it under those inventories. Okay, that's cost. For example, KEMSA imports medical supplies. Import duties are not recoverable. VAT charged on the import is recoverable from KRA. A trade discount was negotiated. So the purchase price there is 5 million. Then the import duties are 400. VAT recoverable is 800,000. Transport is 250,000. Trade discount is what we can say 300,000. Required. Compute the cost of purchase under IPSAS TOLIF. Compute the cost of purchase under IPSAS TOLIF. Then state which items are excluded and why. So this is the solution. Purchase price is 5 million. We include. Import duties is 400,000. We include. VAT recoverable from KRA, we exclude since it is recoverable. Transport and handling to 50,000, we include. Less stress discount. For transport and handling, sometimes it depends. If the asset is already at the first point, at the headquarter, then you don't add transport. But if it is bringing up to the headquarter, then you add. Storage is the same. Storage also you don't add unless it forms part of the production process. So let's trade discount. You remove trade discount, and that is the cost of purchase. Remember, when we are starting, we said lower of cost are net realizable value. Now we understand how cost is calculated. Cost you must include, cost you must exclude, sorry. Normal waste, like for example, the production requires 5 people and you employed 10 people, so those are abnormal waste of materials or labor. Administrative overheads that add no location or condition, that add no location. So selling and distribute, these are normally expense because already the asset, please note the key point here is whatever will bring that asset to its present condition and location to the headquarter. So any other costs are expensed. The selling and distribution costs are or will be expensed. Then we have land cost, but the cost can either be for a single unique item like Mercedes Benz, let us say, or some types of unique vintage cars. Then we use those if it is not interchangeable. If something is unique, we will use its initial cost. But if something is interchangeable, like a tires, for example, you can interchange toners, you can interchange. If something is interchangeable, then you will use cost formulas. Cost formulas, we have FIFO, weighted average. FIFO stands for first in, first out method, weighted average. Then we have LIFO. LIFO is not permitted under IS and IPSAS, and IS2 and IPSAS 12. It is not permitted. So the oldest for FIFO, what happens is the first that entered into your stores is assumed or presumed it will go out of your stores first. So the oldest stock is issued out first. Closing stock is the recent cost. So what we are closing with is the amount that we recently received. Then we have the weighted average. Average. So we take patch 1, this is the cost and this is the volume. Patch 2, this is the cost and this is the volume. And then we add them together and divide by the number of units received, and therefore that will give you a weighted average cost. But LIFO, as I said, is not permitted because even for a shopkeeper, for example, today you want to buy loaf or bread, whichever way you say it, will they sell to you the fresh items, the latest items, or they will sell to you the old items? So what happens is definitely they will sell to you the previous stock they received. Reason? Because of expiry. Whatever we normally do in the private sector under IS2 is what we cover under IPSAS 12. So we normally borrow the best practices. So this is an example. Strategic Reserve Agency holds fuel and buys more during the year. Issues are valued using the weighted average cost. So the first one, the opening balance is 10,000 liters at 150. 20,000 liters is the purchase at 165, and what was issued is 12,000. So we are told to compute the weighted average cost per liter, then value the closing stock of 18,000. So here, first, you will come up with this table. Opening balance is 10,000 times 150. That is 1.5. Purchase is 20,000 times 165. Then that is 3.3. So the weighted average, if you total those together, 1.5 plus 3.3, that is 4.8. So if you divide 4.8 divided by 30,000, you will get 160 per liter. 160 per liter. So if you are valuing your closing stock, the 18,000, you will multiply by 160. That will give you a figure of 2,880,000. Okay, movement, expense, and disclosures. So inventory moves through this. First, the opening balance say is 1,200. Then the purchases you add together. Then The issued is an expense, it's a minus. The write down is a minus, and then the closing is what you can see on the screen. So this is how we normally do. And by the way, it's always good to have the closing balances as one note, then as say 12A, 12B is the movement, and 12C is the expense table. So we can have such things for proper disclosures under IPSAS 12 paragraph 47. So when inventory becomes, when can inventory becomes? Automatically when it's sold, when you sell it, when you transfer it, or when you exchange it, it becomes, or when you distribute it for free, expense. But then once you distribute, if there is a condition attached to it, you apply IPSAS 48. First, you will treat it as an asset, and as the condition is fulfilled, then you expense from your books. So you have transferred it, say, to another entity X, and you are entity Y. So as entity X expenses and meets the obligations, then you will remove that from your books. First, initially you will record as transfer asset, and as that person, a transfer asset is similar to receivable. So as that person fulfills the condition, then you remove from your books. Then we know we have write downs and losses. So expense, sometimes inventory can lose value. Inventory can, if an inventory has lost value, then the cost or the initial amount less the fair value, less the NRV or CRC. So when you less it, any differences you get, you also expense it. The write down means expensing it. Impairment, inventory doesn't have impairment, so you don't take it to impairment. You will adjust those changes inside the expenses, So example 4, a public university health unit issues medical supplies from stores to treat students during the semester. So this cost of supplies issued is 350,000. When is the cost recognized as an expense? At what point do we recognize the cost as expense? And then you are told to give a journal entry. So a service provider expenses the inventory. So what are we debiting? What are we crediting? We are crediting a consumption of supplies 350. Then we are reducing. An asset is increased by debiting, and when you credit an asset, then you are reducing that asset. So those are the journal entries. For example, for when to write down to NRV, cost may not be recoverable for several reasons. For example, inventory is damaged, so physical loss of usable value. So once an inventory is damaged, then it is written down, so it is impaired. So inventory is obsolete, so no longer needed because of technology or rather something else. It is no longer needed or sellable. So what happens? You write down that inventory to current replacement cost or NRV. Selling price have declined. If the selling price market value has fallen of that inventory, that will also reduce the inventory, so that will force you to write down the inventory. Cost to complete or sell have risen. Less recoverable on disposal. So all those are instances where you can write down inventory, So a state department holds pre-printed stationery that's now obsolete. After a reprint, it can only be recycled for a small amount. So compute that down, give the journal entries. So initially the cost is 500,000. Current cost or net realizable value is 120,000. The difference is about 380,000. So debit expense 380,000, credit inventory by 380,000. Okay, that is example 5 solution. Disclosure: what the financial statement must tell the reader. This is paragraph 47. Accounting policy: measurement basis and cost formula used. Carrying amounts: total and by classification of inventory. Expense: amount of inventory to be recognized as expense. So the first three, normally it's in a form of TOLIF, the main one, TOLIF A and TOLIF B. So you can come up with those notes in a way that follows the disclosures of IPSAS TOLIF, paragraph 47. Write down amount written down and any reversals were reason. And by the way, when we are reversing, we don't treat it as gain. When we are reversing the write down, we will not treat it as gain. What we will do is we will reduce our expenses for the subsequent year. We will reduce. So if previous year you have written down say 500,000 and this year it has recovered, you will recover the 500. It has recovered so the gain, you will reduce the current year expenses. You will reduce the current year expenses. So common mistakes: carrying stamps or currency at face value, not cost. Those are some of the mistakes. So face value, for example, 1000 shillings, instead of looking at the cost of producing that 1000 and your central bank, then that is wrong, and that is one of the mistakes we normally make. Capitalizing storage, admin or selling cost. So sometimes you capitalize storage. Storage should never be capitalized except in instances where they are part of production. For example, the storage cost is, first you started with, let us say, it is milk and you are converting to yogurt. So as it awaits the conversion to yogurt, for example, then that storage is accepted to be capitalized. Otherwise, when you are selling this item and it is ready to sell it in the market, any storage cost, won't form part of what you will capitalize. Ignoring write-downs on damaged or obsolete stock. So we ignore, and I know mostly it happens even in the public sector. It's common. So I know as we advance, please record these write downs or obsolete stocks. And by the way, whatever you debit, you should also have the corresponding credit. If you don't do that, then your financials won't balance. Recording donated assets at zero. Why do you record at zero? So IPSAS guides us, we go back to the market and check for a similar item in a similar economic similar condition and compare the two and say this is the price you will get for a similar item. And sometimes if that is not available in the market, then you can seek professional help, so they will help you to value your assets. So those are the common mistakes. Here is where we check our understanding. Question: drag cost Kenyan shillings 800,000. NRV is now 620. At what amount are they carried? Are they carried at 800, always at cost? Are they carried at 620, the law of cost and NRV? Are they carried at Kenyan shillings 710,000, the average of the two? Or are they carried at 1420, the addition of two together? So cost plus NRV. So if you look at this, I could say P, the answer is P, 620,000. So why 620? NRV of 620 is below cost. And we say we will measure lower of cost and net realizable value or current replacement cost. So what we will write down in that period is 180,000 as expense in our books. So in summary, we say inventories are measured at lower of cost and NRV. Cost, we said, is cost of purchase, the all items related to the import duties, purchase price, non-refundable taxes, and then we less trade discounts plus conversion, cost of converting that into finished goods, and then we plus other costs that is related to bringing that asset in its present condition and location. We said we will exclude abnormal cost, storage, admin overheads, and then admin overheads, and then marketing and selling cost. Will exclude those. Then we say we can either use FIFO or weighted average, the cost formulas for similar stock. Then we said we don't include LIFO, and I gave a reason. Then we expense when sold, distributed. Then we disclose by class. Thank you for watching. Please subscribe to my channel. Enjoy your day. Until we meet again, thank you for your time.